Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will speak about the Crisis Hedge Trading Strategies.
Hello everyone, my name is Radovan Vojtko and I'm CEO of Quantpedia. At the time I'm recording this video, the stock market is in bear market. We had multiple bear markets in the past: coronavirus crisis, global financial crisis, tech stocks meltdown. We had Asia crisis in 98. So the current bear market is not the first one, and is definitely not the last one. So it's better to be prepared for the future bear markets. And how you can prepare as a quant for a future bear market? The best is to have some hedging strategies in our portfolio of systematic trading strategies, because those hedging strategies, they should perform exactly at the time when there is a crisis. And how we can find these hedging strategies? So that's nothing more easier. We just need to go to Quantpedia and we can select, here we have a field which is called Crisis Hedge, and we can easily select that we want to see only those strategies that have the hedging properties. We have more than 100 of such strategies, and I will show you a few of them. I selected the currency momentum factor. Initially, the momentum initially discovered in the equity market is well known, is well researched, is a robust anomaly. It's working not only in equities but also in currencies, or was working in currencies, and it was or is sometimes used as a hedging strategy. Then we have a momentum effect in the commodities. I spoke about this strategy in the previous videos, so I will not speak a lot about that. It's basically a common momentum strategy where we select commodities that are performing well, go them long, and we short the commodities that have negative momentum, and we rebalance our portfolio. Time series momentum strategy. We have a globally diversified portfolio of equity futures, fixed income, commodities, and currencies. Select those that have the positive momentum and go long. We select those that have negative momentum and go short. And our portfolio is volatility weighted, so it means the assets or futures with the high volatility have a lower weight, and assets with the low volatility have a higher weight, so that the risk contribution of each individual future is approximately the same. And the last strategy is Giveness effect in commodities. I already mentioned this strategy in a previous video. What we do, we have a pool of commodity futures. We select those that have the most positive skewness and we go short, and we select those that have the most negative skewness and we go long those futures, and we rebalance the portfolio, let's say, on a monthly basis. Those are the strategies, and what is the effectivity of selected crisis hedge strategy. We wrote an article about this question in July 2020. Now today is 2022, but the result of the analysis is not significantly different. We use the time frame of 20 years for our analysis, and we checked three groups. The first group contained systematic crisis hedge strategies, currency momentum, commodity momentum, time series momentum, and skewness, as I mentioned. The second group contained equity factors, and the third group contained the assets that are usually safe haven assets, so it means US dollar, US Treasury futures, and gold. What we were interested to see was not just the performance. Here is the time series of systematic crisis hedge strategies. Here is the time series of equity factor strategies over the last 20 years. And here is the performance of time series of safe haven assets. So those assets that I mentioned. What we were interested was to see how those strategies and how those safe haven assets perform when the equities have a negative month or during the negative months on the stock market. Let's see. So the first group, systematic crisis hedge strategies. On average, during the last 20 years, when we had negative amount on equities or a negative amount in the market, the performance of the equities was minus 3.6%. And what was the performance of these selected crisis hedge strategies? The currency momentum factor had a zero performance, and all of the other momentum effect in commodities, time series momentum effect, and skewness effect in commodities, they had a significantly positive performance in the months when the equities had a negative performance. For those that are interested, we can see also the downside correlation. So we can see that the time series, especially time series momentum and skewness effect in commodities, they have significantly negative downside correlation to equities during the months when the equities are in drawdown. What is the hedging effectivity of systematic equity factor strategies? Those strategies are value, reversal, size, quality, momentum, low volatility, and investment. So we checked 7 time series of equity factor strategies. Your average performance of equities during the negative month is minus 3.6%. On value side and reversal, they cannot be considered as a crisis hedge strategy, but the quality, momentum, low volatility investment, all of them had positive performance during the months when the equities had a negative performance in the last 20 years. So those 4 factors that are interesting and they can be selected as a crisis hedge or into the crisis hedge portfolio. The quality and momentum, they also had significantly negative downside correlation. And what is the hedging effectivity of safe haven assets? So as I mentioned, gold, US Treasuries, and US dollar are sometimes considered as a safe haven asset, the asset that should perform when the equities or when the stocks are in stress. Of course, it is not working in the current situation in 2022 because we have inflation problem and US Treasuries are also in the drawdown at the same time when the equities are in the drawdown. But in the last 20 years, all of those assets, gold futures, US Treasury futures, and US dollar futures, they had a positive performance during the months when the US equities had a negative performance. Especially US Treasury futures and US dollar futures, they had also the significantly negative correlation. What does it mean? It doesn't make sense to select only one crisis hedge strategy or one crisis hedge method because we can be in the same situation as we are in the moment. So it means that the US Treasury futures are not performing well at the same time that the equities are not performing well. So it makes more sense to create a portfolio that can be built from the safe haven assets or crisis hedge strategies. But it makes sense to do this type of analysis to understand what is the behavior of some strategies, and you can see that some of the strategies can be considered as a crisis hedge. So thank you for your attention, and I would be happy to see you in the next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.